Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. This episode we are going to talk about the do-it-yourself investing, the do's and the don'ts and the mistakes that people make when they're trying to do it on their own while trying to save costs. It's not a bad thing to save costs, but you've got to do it the right way. But before we get into that conversation, something that we do every show, which is talk about the big question of the day, of the week. And let's first talk about the redemption pressures which might be faced by the non-bank lenders over the course of the next three odd months. More than a third of the debt raised by NBFCs from mutual funds matures in the next 3 months. According to a report by Credit Suisse, this amount adds up to 1.3 lakh crores. So should retail investors be worried, especially given the exposure to stressed corporate that some of these funds and investors might have? That's the big question of the day. And to talk about this big question of the day, we're joined by Radhika Gupta, CEO at Edelweiss AMC. Radhika, thanks so much for taking the time. I really appreciate. I remember when the first murmurs of this started, which was 6 months back, when the problem was real. It was a clear and present danger then. There was a lot of fear amongst people and amongst not just retail investors, but advisors as well, about how will the mutual funds and the NBFCs both navigate through that uncertainty. Now, this talk has come up again. Over the next 3 months, 1.3 lakh crores. Is there a reason to be worried?
See, I don't think you can, I said it then and I'll say it now, I don't think you can paint all NBFCs or all MFs with the same brush. I think that's what the last 6 months have taught us. If you look at it historically, NBFCs have been an important part of mutual fund exposure. In funds like liquid funds, cash funds, etc., 25 to 30%, at some point 40% of the exposure has been HFC and NBFC. As I said, I don't think all NBFC, HFC is the same. There are very good quality ones in the pack, and there are a few odd names that have been stressed. I think over the last 6 months, where you have seen a lot of rumors in terms of NBFC, non-payments, etc., the cases have been few and far between. So as an aggregate, should retail investors be worried about this 1 lakh plus crore number? I don't think so. Given the size of the debt mutual fund industry, is it a big number? Yes. Is it a concerning number? No, it's not. And one expects that most of these NBFC payments will happen on time. They have been happening on time. Even in the most stressed of conditions, they've been happening on time over the last 6 months. I think what retail investors have to be cautious about, Neeraj, is the quality of the underlying fixed income portfolios that they're holding. As an advisor, as an investor, there certainly has to be a lot more scrutiny about what you are holding in your portfolio, particularly knowing that debt portfolios are not ones where you're trying to take incremental risk to earn a huge amount of money. That's equity. That's clearly equity. So in debt portfolios, you just have to make sure that the quality of what you're holding is intact and keep a check on that.
Okay. Last time around, Radhika, and I take on board your point, largely we haven't seen any kind of major defaults that would have resulted in losses to a holder of a fixed plan or a debt plan because of non-payment or late payment by any of these NBFCs to AMCs. The question is, at that point of time, there was, for a bit, there wasn't maybe too much of action taken. Then there was some proactive action taken by the central bank as well in order to help the system, confessed by the NBFCs themselves. You reckon that while there may not be defaults or late payments in a meaningful way, there will need to be some exceptional measures taken by the regulatory authorities or the regulatory bodies as well, or will the system by itself adjust and make sure that there are no major accidents?
I think the system is a robust one. That said, while all of it doesn't come out in public domain, I think there is tremendous regulatory watch over what is happening. I can speak from an AMC industry perspective. So I think regulators are very cautious about the fact that there is large fixed income exposure. There have been a couple of fixed income incidences of default, deferment, rollover, whatever you may call it. So I think there is tremendous oversight. I think the amount of oversight that mutual funds are subject to from the regulator and also from their trustee boards has gone up and will continue to go up. We see that, and we expect to continue to see that. So that will definitely happen. I would just tell investors one thing, that even in the toughest of cases, they're not down materially on capital. I think if you look at some of the credit risk funds which were out to take credit risk, Neeraj, where there have been defaults also, and you look at the 2-3 year return, investors are not that badly off. It's psychologically difficult to see a default in fixed income. It's psychologically difficult to see even mark-to-market risk in fixed income. But net, if people have held through the holding period, then actually there has been no material capital loss in most cases. So I think that should give you a lot of comfort, and know the fact that regulatory oversight and also trustee oversight on MF as an industry is materially going up.
Okay. One small question, Radhika, and the belief largely has been, and maybe rightly so in certain cases, that most of the NBFCs have found it relatively difficult to raise funds in the last 6 odd months. Now, you are in a house which is also a large NBFC and an AMC, under that umbrella. What do you think has happened in the last 3 months? And if there were to be a situation wherein a large repayment comes up for you, do you reckon the system has now expanded a bit due to some liquidity, a lot more liquidity in the system now for NBFCs which may even be under stress, to be able to go out and raise the capital in order to ensure that the name doesn't come under the default or the late payment category? Because I remember last time when something like this happened, even if with a bit of a delay the NBFC was able to make the payment, there was a lot of brouhaha when the first instance of a late payment or a default, whichever terminology you use, happened in the first place.
See, I think, as I said, you can't paint all NBFCs with the same brush, and I'm speaking, for the sector as a whole. I think over the last 6 months, good quality NBFCs have been able to raise money, whether it is raising money through public issues, whether it is raising money through mutual funds, whether it is raising money as equity capital. There have been all kinds of instances over the last 6 months. And just like when you see a crisis in equities and there's a material correction in prices, good stocks do find their buyers. I think good NBFCs have also found their lines of funding. People have used it as an opportunity to back companies with solid management, solid stories. So I think that's the story that has panned out over the last 6 months. Yes, there have been a few oddballs that continue to see stress. Will that continue? Could that continue? Sure, but you can't paint the whole sector with the same brush. And I think MF as a category as a whole, we continue to invest, as Edelweiss AMC, we continue to invest in NBFC paper. We are selective about what NBFCs we hold, and within that we have not seen stress in our repayments.
Okay. Kunal Bajaj of MobiKwik also with us, and before I ask the final question to Radhika, Kunal, you want to come in on this as somebody who is advising and as somebody who is running a platform which has a large number of customers as well. Any thoughts that you have on this?
Sure. I broadly agree with what Radhika is saying in terms of, the better NBFCs being able to refinance. But I think structurally we have to look at the way the retail investor looks at debt mutual funds, equity mutual funds, and other fixed income instruments. While retail investors form the largest chunk of the number investors by number in equity mutual funds, the equation is actually almost entirely reversed when you come to fixed income. And in fixed income, you find that the corporates are actually the largest investors because they look at fixed income funds or debt mutual funds as a way to park short-term monies. So really what happens when the system loses a little bit of confidence in the repayment ability of certain NBFCs, and certainly not all NBFCs, but certain NBFCs, I think that there is certainly some element of risk of a liquidity crisis playing out as these repayments happen over the next couple of months. Because if you have to think about the retail investor looks at very, very simple instruments like public provident fund, look at bank fixed deposits as guaranteed return instruments on which they know how much money they're making. They tend to bucket their safe investments into these products and their riskier investments or long-term growth investments into equity mutual funds. And debt mutual funds form a very, very small small component of it. So really speaking, psychologically, the investor is totally happy to take a drawdown or a fall in prices of their equity mutual fund by 20 or 30% in a bear market, but doesn't even want to take a small, drop in their fixed income mutual fund pricing or NAV, simply because the psychology is that this is zero risk. And I think that that's where some of the liquidity issues may crop up.
So maybe it ties in part with what Radhika was trying to say as well, that you don't paint the whole industry with the same brush. There could be an accident or two here and there, but that's something that could happen at almost any given point of time with almost any given product. By and large, the risk would be very, very minimalistic, even if it's there.
Yes.
Okay. My final question, Radhika, on this topic before we move to the next piece, which is the do-it-yourself piece and things that you should keep in mind. I don't know if you want to respond to what Kunal said, but my final question to you would be, as an AMC head or the AMC CEO, when these papers now come up for renewal, would you be comfortable doing that? Because, I buy your argument that a lot of NBFCs have been able to raise money in the last 6 months, but we've seen a bit of a dichotomy between the really large ones, which have found it relatively easy to do that, versus grade C, I won't say grade B, but grade C NBFCs, which have arguably found it a little difficult. Would you be comfortable rolling over all and investing fresh capital there, or would you be very, very selective now?
So 2 points, Neeraj. One, I absolutely agree from a retail point of view with what Kunal said. And I'll just comment, I think when you talk about a broader movement in the lines of MF Sahi Hai, retail investment in debt mutual funds, retail plus HNI today is about 4 lakh crores, of which retail must be 1 lakh crores. The fixed deposit market is 120 plus lakh crores. So that in some sense is the lost opportunity or left opportunity for debt mutual funds. And he's absolutely right, because the mindset you come from is PPF, small savings scheme, FD, you are looking for predictability of returns. So a little bit of hampering causes a lot more agony than being down 30% in a mid-cap fund. So I absolutely agree with him. But I do think that you can't have retail get scared about one. If retail were to get spooked by 1 or 2 defaults and step away from debt mutual funds, especially given the tax advantage and liquidity they carry, that would be a big misstep for the industry. So I hope as a result of all this, that doesn't happen. You don't stop investing in debt mutual funds because we've seen 3 defaults. I think responding to your question, as an AMC, will we continue to hold NBFCs? Of course we will. Will we roll over all exposure? Maybe, maybe not. Will we certainly be selective about what we are doing? Yes, we will. We are also very careful about mandates. See, there are different kinds of debt mutual funds. Just as there are different kinds of equity mutual funds, there are funds like liquid and liquid plus funds. There are funds on the other extreme like credit risk funds, where the job is inherently to take credit risk. So we will take risk in fixed income depending on the mandate of the fund, and communicate a lot more proactively with our investors about the kind of portfolio that there is. But certainly there'll be a lot more. There has been, and there will continue to be selectivity about what NBFCs to back. That continues in our portfolio. It's always been there, and it goes up a notch.
Okay. Yeah. I think at some point of time, maybe people will need to learn to dissect. Having a conversation with somebody was saying that maybe the terminology of fixed income plan needs to change, and it should just be broadly classified as a mutual fund, because people shouldn't believe that this is fixed in its nature. Yes, historically it has been, but there is some element of risk that comes in when you make an investment for a slightly higher return than a fixed deposit. And I think that's something that all investors should take on board. And which brings me to the next conversation. It ties in beautifully with the thing that we wanted to do, which is how India and investors have stepped on to the digital age, online, for not just shopping and payments, but for investing and financial planning. And the mistakes that so many retail investors make when they try to navigate through the multitude of options and decide on the right product, the do's and don'ts of online mutual fund investing. And it goes on into the debt market as well, because hey, if you have an advisor, the advisor will tell you that it's not a fixed return, and he will give you solace if there is some bit of mistake that's happened. But what if you don't have that? What if you're investing in products, or what if you're investing in mutual funds through offerings given by let's say Kunal's company, which was earlier Clear Funds and now MobiKwik. And Kunal, Radhika, I would request you to stay on this as well, but Kunal, I want to start off this conversation. the simplest mistake that I think a lot of people tend to do, and we've seen this happen. I've had conversations with Radhika about this as well, is that you sort the returns of mutual funds by the last 1 year, tend to invest into the best performing fund, and voila, you realize that next year the returns are not the same. I mean, there are this and multitude of other mistakes. Can we start off with this one first, though?
Sure. So, this is clearly a very obvious mistake, but I think let's talk about the positive aspects to begin with.
Sure. Okay.
And the reasons why someone should even think about an online investment. So, firstly, I think, while the mutual fund industry, and Radhika is here joining us on video as a guest, I think they've done an absolutely stellar job in terms of the assets under management, which are growing year after year and growing in line with the economy and, possibly even ahead of, general economic growth. But I think where the mutual fund industry has not done well is in financial inclusion. And after about 25 or 26 years after the first private mutual fund was launched, we're talking about Morgan Stanley possibly in 92 or 93, we only have about 2 crore unique individuals who've ever invested in a mutual fund. We're talking about 135 crore population, right? Let's assume that some of them are clearly out of the income bracket or the target market for personal financial savings. But even then, it's a shockingly low number.
Sure.
And one of the primary reasons for this is the last mile to reach the customer, to reach the investor, to reach the user, which really has been the traditional advisor who puts on a suit every morning, comes and meets you and tells you, Neeraj, I think you need to start investing in this particular manner. And the problem is exactly this, that the operating cost of a traditional model is so high that the only way the market can grow, the only way that we can do proper financial inclusion is actually by taking investing, payments and all of these other financial services onto a mass platform, onto taking them online. A great example of that would be the number of bank accounts we have. So we have about 958 million debit cards in India as of December 2018, which tells you that 96 crore people actually have bank accounts, but only 2 crore of those have invested in mutual funds.
Yeah.
So, firstly, I think there is a large opportunity. And the reason why an investor would want to invest online, to me, there are just 3 reasons. The first is convenience, is the convenience of investing anywhere you'd like, at any point in time. And over here, I can even talk about the fact that, people are buying groceries online, people are buying clothes online. Hell, people are even finding, their life partner or their evening partner online on Tinder. So why don't you invest online? So, convenience is a really important aspect. And today with, KYC being completely automated, setting up your bank account being automated, it's a 2 or 3 minute process to actually start your investment journey rather than, having to fill out forms and paper. The second reason someone would invest online is actually choice. So typically when you go to an advisor, the advisor comes with his preconceived notions and then offers you, a certain set of mutual funds because either that's the company he or she works with or he's comfortable with. But, when you go online onto any of the large platforms, including ours at MobiKwik, you do get the fund recommendations, but you do have the choice to invest in any mutual fund that you choose to. So there is that element of choice which is available, which may or may not be available with the advisor that you're working with.
Sure.
And the final reason is clearly cost, right? So it's basically cost, convenience, and choice. And these are the reasons why we think. And finally, the cost element is important because what we're able to do is accept small ticket investments. I mean, you can do start an SIP with as little as 100 rupees on our app on MobiKwik, and this is something that we can provide because we already have the customer base. And adding another feature like mutual funds is very, very easy. Whereas for a traditional advisor to deal with somebody who wants to do a 500 rupee SIP or a 1,000 rupee SIP probably doesn't make economic sense.
No, so this is agreeable, and I will get Radhika to come in on this first before we get to the topic of what are the things that one shouldn't do. I mean, Radhika, I take on board the point completely, right? You can't argue against convenience, you can't argue against cost, you can't argue against choice. But my question is, I mean, even for the online customer or the non-online customer, the choice would stay probably. But the question largely is that let's assume that there are people who are convinced with the arguments that Kunal is making right now. They're still going out and making those mistakes, and that's what people should try and minimize. That's the attempt of the next 7 or 8 minutes of this discussion, to try and tell people what is it that they should not do. What is it, Radhika, that comes to your mind when you think of mistakes that people are making when they are not adopting the traditional route but going through this online, more convenient, more cost-effective route?
Sure, and I will definitely address the mistakes. I'm just going to give a 1-minute spiel because I have a firm belief in we as Edelweiss AMC have always we run this brand campaign advice zaruri hai. We do believe that whether you're investing online or whether you're investing offline, investing, as you said, Neeraj, is very, very behavioral. It does not come down to just selecting funds. Unfortunately, it's not like going to the grocery store and saying I need 2 bottles of jam and 1 toothpaste and this and that. It is very, very customized. It is very, very goal centric, and it's very, very personalized. What's right for Radhika may not be right for Neeraj, may not be right for Kunal. So we believe that most people, whether you choose to invest online or offline, need the element of financial advice. At least that's a belief that's very core to us. Coming to mistakes, I think there are a couple of things that people do online or offline, actually, though the worlds are not so different, but I think online you see this a little more exacerbated. One is looking at what's in season. So traditionally the model is go on an app and select the asset class or the fund that's had the best last 3-year return. Without knowing that scheme category may not be right for you, and what are the reasons for that algorithm to show what it does. For instance, at the end of 2017, most online investors, and we see this in the sales of our own scheme, would have gone in and probably invested in a mid or small cap fund because the 1-year return was looking outstanding, the 3-year return was looking outstanding. Now, clearly, for a majority of people, and there's nothing wrong with mid and small cap, that's not their risk appetite. So you've gone and done a blanket investment in that asset class because it's been the best performing asset class. And then you've gone through 2018 where the asset class has done terribly, looked at your online numbers, and then probably made a decision that's not very good for you. So I think that's the biggest mistake that people do. They sort on the basis of returns, and investing is very counter-cyclical. I think it also leads, Neeraj, to a case of expectations mismatch. When you look at things numerically, markets give you on average about 10 to 12% a year. Unfortunately, that 10 to 12% is not 10, 10, 10, 10, 10. It's plus 30, minus 30, etc., etc. You look at the online screen and you see 30-40% in a mid-cap return, your expectations are anchored to that number, and that can become very, very dangerous. So it's very easy to get disappointed going forward. So that's mistake number one that I would recommend all online investors don't do, is look at what the past is.
That's a fair point. Kunal, sorting, and that's the biggest culprit, right?
Sure.
So maybe some thoughts on that, and what else, because you run an online platform for so long, what is it that you believe people tend to do? Let's assume people are convinced about online, so they're coming to your site. What is the mistake that they're doing when they're coming to your site?
No, as Radhika said, I think the fundamental mistake that a lot of retail investors or first-time investors actually make who haven't seen a cycle. And you have to remember that a lot of investors who started in the market in the last couple of years had never seen a cycle because they're first-time investors who actually never lived through 2008, 2009 and saw the volatility of that period. And obviously the mistake they would make is, in extrapolating prior returns. So whether it is sorting my 1-month returns, sorting my 3-month returns of the last 12-month returns, it's a natural behavioral, human behavior to expect that the past will repeat itself in the future.
So therefore don't do that.
So therefore, clearly that's something that you should avoid. You should, as far as possible, try and look at a concept called rolling returns. And rolling returns is a concept where you look at, every 12-month period, going back, say, the last 10 years.
Would this data be available,
right? So
say, on a site like yours?
So this data is available, and we try and basically give it so that it gives you it tells you more about the consistency of the fund performing in a particular manner, rather than letting just the last 3-month or 6-month or 9-month data show a false, or rather show an overly aggressive or an overly conservative picture of performance. So that's one thing. Secondly, I think a lot of AMCs have been quite responsible in the way that they behaved through 2017 and 18, and there were a number of AMCs. I mean, for example, DSP is one that I can think of off the top of my head, where they actually shut all subscriptions into their small cap scheme. At that time, it was by far the most popular scheme around was DSP Microcap, which has been renamed now, I believe, to small cap. But they actually ended all purchases of that small cap scheme. And as responsible advisors, what we did is basically also tell our customers customers who had SIPs into that. Although the AMC allowed SIPs, we actually stopped all SIPs as well, saying that if the fund manager does not believe that he can generate returns over the next 2 years, and they will open the scheme up for fresh subscriptions as they have since then we don't think that this is something that our customers and our clients to do in their best interest. So the onus is not just on the, it's easy to say that the onus is on the customer and the onus is on the advisor to stop making these mistakes. But what I would like to welcome, and what we've seen an example of earlier, is AMCs actually owning up to that themselves, saying, look, this is not a product we would want to sell any longer. Because, mis-selling at the end of the day is done by advisors, but mis-selling is certainly facilitated by the AMCs themselves in the products that they create. The second point I'd like to make in terms of advisors is, yes, of course, you should have an advisor. As far as possible, you should be educated enough that you are your own advisor, right? Take your own counsel, and like you said, the owner also eats here. You see it in the best of restaurants, the places at least I like to eat at. But really, when you're taking your own counsel as an advisor, or you're using an advisor from somewhere else, just having an advisor doesn't solve your problem. I would call this the bad uncle problem. Just because I have an uncle doesn't mean I've solved my problem. He could be a bad uncle or a bad relative who's actually not working in my interest. So, yes, it is important for you to have an advisor, but like I said, either be your own good counsel, find a good advisor, or, keep your own counsel by educating yourself and watching, reading as much as you can, watching shows like this, hopefully.
Yeah, okay. And anything else that people commit as terms of mistakes? Final 2 minutes on the show. One question to you, one question to Radhika. Anything else that people are doing as mistakes when they're coming to a platform like yours, which they shouldn't?
Well, I think the only mistake that people make, that young people make, and it's a mistake that I would confess to myself as well, is not realizing and recognizing that we actually have 40 to 45 years of working life. You start your working age in your early 20s, let's say 25. You retire when you're 65. You have 40 years that you will be saving. And over such long cycles, it's almost inevitable that equities will end up making more money for you. Unfortunately, I think we come from a country of scarcity. We haven't seen, plenty in our, in our generation at least. And in our earliest earning years, we tend to save up more on the fixed income and debt side than we do on equity. And that's a mistake that I think, the younger generation is quite cognizant of with the kind of educational aspects that, Radhika mentioned, mutual fund sahi and so on. The more you save in equity, the more time you give yourself. And it's almost certain that there will be economic cycles. I mean, no economy grows up in a straight line. No market goes up in a straight line. But if you give yourself enough time, you actually take the volatility out. And over long periods of time, you will almost always end up making more money in equities than in fixed income. So really, there are only 3 secrets of investing. It is save more than you, spend less than you earn,
Sure.
which means you save some money. The second secret is to have as much of SIPs as possible, or rupee cost averaging. And the third is to be lucky and, to be born in a generation where the markets are going up. And, I think the first 2 are necessary conditions. The third is a sufficient condition which is out of your control. But you just have to trust to your, destiny, and things will work out.
Sure. Well, let's hope people do that. Radhika, just one final question and again, on this conversation, and again, from a perspective of somebody who might be logging into the Edelweiss AMC website directly to invest, or logging into platforms like MobiKwik to invest, is that when people log in and pick up a fund, is it fill it, shut it, forget it principle? Because if you don't have an advisor, and if you're going online, with the presumption that you understand funds a little bit, it'll be important to even maybe get in and get out of funds as well, which might be facing issues, and therefore go out and understand these funds, right? Your advisor will give you advice on all of that. But if you're going direct online, then it gets added onto your plate, and you should be ready for that, right?
I think there are 2 parts to it, Neeraj. I think one is that it's not about the fund. One, it's about your asset allocation. Now, presumably, if you're doing DIY, you have a sense of asset allocation. I think it is fill it, shut it, and forget it to some extent, but it's not completely. When you go online and add a fund, remember where it fits in your overall asset allocation. Never let that get out of whack. I've seen people go online and suddenly equities are 80 to 90%, and just by clicking and clicking, they've bought equity funds, and suddenly asset allocation goes out of whack. I mean, the one principle of investing to get right, in my view, is make sure that you have a consistent, disciplined asset allocation that is right for you. The second thing is that, when you hold a fund, You have to give it time. So it is fill it, shut it, and forget it for a while. Remember, you don't review a business. If you had a factory, you wouldn't review that factory every 3 months. And if you had a bad 3 months, you wouldn't shut your factory. So the same principle applies to funds. If a fund underperforms for 3 months or 6 months or even 1 year, give it time. Unless there is a material governance or fraud kind of event, which is very, very rare, it is fill it, shut it, and forget it. Once a year, do a portfolio review. Maybe after 3 years in an equity fund, do a review of whether the fund is beating the benchmark, etc., etc. So give the process time.
Okay, I think that's the common advice coming in from both our guests today on the show. Radhika, really appreciate you taking the time out and joining us on such a short notice. Kunal, same goes for you. Thank you so much for agreeing to do the show today. And viewers, hope you learned something about what you should be keeping in mind if you're going out online and investing in yourself without having an advisor on board. It's a wrap on this leg of the Mutual Fund Show. Stay tuned to MobiKwik.